Right on. Love that intro, right?
Yeah.
It's pretty solid.
I was waiting for the kick.
Yeah. Welcome to Freight Forecasting. I'm Mike Vincent, your host. Joining me today is Zach Strickland, and you are Director of Freight Market Intelligence. Is that right?
Correct, sir.
Excellent. Yeah. And we have on the phone joining us today Senior Editor Maritime for FreightWaves, Greg Miller. How are you today, Greg?
I'm good. Thanks for having me.
Yeah, excellent. So obviously Maritime is going to be a little bit of a part of this show today as freight forecasting. We look at all the different data sets that you can use and should use for forecasting the freight markets. Difficult times right now, trying to forecast anything into the really near future and certainly long future, right?
Yeah, difficult forecasting anything at this point.
Yeah, very, very, very difficult. And so bringing Greg on with the maritime perspective, Greg wrote, and let me read this, container lines provide a window into the future of U.S. cargo flows, not in the sense of reading tea leaves, but in the sense of inevitability, like death and taxes, right?
Strong editorial.
Yeah. So I'm going to bring up, and if we'll put this on screen, a sonar dashboard, and Greg, kind of talk to what you mean by that.
Well, are you in terms of California, for example? You can see the surge in cargo going on right now, or in early April, and your first thought would be recovery. But what you're really seeing is the cargo that was loaded several weeks ago. What you're really seeing is what happened after the initial shutdown in China, where the factories in Wuhan closed. And then after they reopened, everyone booked the cargo, and it's finally coming here. So you can see from the past.
Hey, Greg, you lost your audio there. You really faded out. But what he was saying is you look at the cargo coming in, and the surge that is happening. And when you're looking at this screen, if you bring the screen back up, when you're looking at this screen, you're looking at, on the left-hand side are all the ports, right? So these are port exports and the trends that are going on there. Now, this is the daily as of last value for all these ports. These are exports to the United States. And you see a lot of green here. There was much more green over the last month, and really certainly over the last few, like 2-3 weeks. And to the right-hand side, what you're seeing is the maritime U.S. Customs Maritime Imports shipments into the U.S., and then specifically in the green is Los Angeles, right?
Yep.
And so when you're looking at the freight markets, you've got to be watching this type of information and seeing what is going on, because the maritime absolutely affects surface transportation.
100%. I mean, the idea here is that, most of the freight that we ship, especially on the retail side of things, comes in from China. Your electronics, your consumer products, a lot of that stuff has an influence from China. So looking at the things that we're bringing into this country are extremely important, and knowing what kind of inventory is available for trucks to ship in the United States. Now, does it translate immediately into truckload volumes? Not necessarily. It can, depending on the environment that you're in. Obviously, if you have low inventory levels and we're experiencing spikes in demand, those imports can really signal a strong increase in demand and truckload flows in the United States.
Right. Yeah. Exactly. And what I've done that is there. And Greg, just speak up when you have your audio back, so we can hear you. I'm not sure if he's going to come back. Hopefully, he does here soon.
I'm here. Can you hear me?
Okay, great.
Can you hear me?
Yeah, great. So we're talking. Okay, so we were talking about the effects of maritime on surface transportation, and what I've got up now is the maritime import shipments into the port of Los Angeles, California. Over the last couple months, I've got it on a 3-month, and then I have the O-Rail 40 loaded, or the outbound 40-foot loaded intermodal containers out of Los Angeles, and you can see a relatively perfect correlation here between imports and the rail. So Maritime absolutely affects that, and it affects that local drayage, obviously, in a short and local and short haul when you're talking about Los Angeles into the Inland Empire, Ontario, where there's a lot of warehouses, right?
It could change, though, coming forward, because what we're hearing is that all of the cargo that's coming into the ports now, again, was the cargo that was booked right after the Chinese shutdown in early February. In late February, all of the U.S. cargo buyers just ran out and tried to cancel their orders. And so what we're seeing now is the cargo that's coming into California is going to cargo orderers that no longer want the cargo or no longer can get the cargo. So you may see a divergence there. And actually, the terminals are quite concerned about this. They think that these boxes are just going to pile up because no one's going to pick it up. So that may change in terms of the correlation with trucking and rail going forward. We'll see.
Yeah, that's a very interesting point, right?
That's fascinating.
So let me it plays into really. Let me pull up this other chart here, because what where we're going is obvious that you have to look at multiple different data sets to understand the freight markets, even if you're your freight market is Dallas or Chicago or Joliet or Memphis or wherever it happens to be, or the Inland Empire in California. You've got to be looking at the maritime, the air, the rail, the truck, and then economic indicators, manufacturing, the IMS, the LMS, et cetera, to understand what's going on in these markets. And I'm looking at the Maritime Imports shipments, and if you can pull this up on screen, it's Maritime Import shipments into the Port of Los Angeles, and then I'm looking at city and short haul volumes, truckload volumes, for both Los Angeles and for Ontario or the Inland Empire. And you can see early on in 2020, in January and through February, and if you go back, we can go back further, but this time frame really from the beginning of 2020 through this month is really the time frame we want to look at here. And you can see a very strong correlation.
Yeah.
Right? When there's upticks in imports, the short and the local react.
Yeah, out of Los Angeles specifically. I think it's important to note that, the short haul volumes themselves, immediate impact is going to happen with the truckload side.
Right.
However, the rail volumes, which are going longer haul, happen more immediate as well.
They do, but then it goes down the line.
Yep.
Right, and we've talked about that in other episodes, Greg, where you can see the maritime imports, and then it lags and hits the rail, and then it lags and then it hits, say, the local and short in Dallas and Memphis and Chicago and Atlanta, et cetera, at the end of the line of those rails. And
sure.
And so,
if you think about it, though, it makes sense, though, that if your distribution centers are having problems operating, or your warehouses are having problems operating because people are at home, or if you're a business that is closed, if you're a restaurant or whatever, it makes sense that you're not going to want to take delivery of that cargo. And that's something that's going to increase going forward.
Yeah, because when you look at this, what happens here in March is you see this total divergence. There's no correlation here, right? You see imports drop, yet they go through the roof. These volumes go through the roof.
Right.
So what was happening there, Zach?
You're looking at the translation between maritime and trucking.
Yeah.
And it's not a one-to-one in terms of timing.
It's also not 100% correlated to. There's other factors.
Yeah.
There's manufacturing, and there's surface or domestic origin freight that is also affecting these volumes as well, right?
Yeah, absolutely.
So the maritime is one of those indicators and can help you with those volumes. But then what you saw here is absolutely the maritime goes out, and then we see the draining of the warehouses start to happen.
And what's interesting to me about your article, Greg, was the fact that we're talking about, a delayed impact of these void sailings, as we're really just starting to breach that point of where cancellations are having an impact to the domestic import side. Is that accurate?
Absolutely. Yeah, absolutely. It's natural when a crisis is going on to expect an immediate effect when it comes to ocean shipping, there's always a delay. It takes 14 to 22 days for a container ship to get from China to the West Coast. It can take 30 to 40 days for a ship to go from China to New York, going through the Panama Canal and stopping along the way. So you have to look forward in time. As far as these canceled sailings, it was reported as of last Sunday that there were 435 sailings canceled so far for the first half of this year through the end of July, which is an incredible number. And the way to translate that into U.S. sort of domestic freight, what you have to do is you have to look at the sailings from China that are coming to the U.S., when they're departing, and then you add that transit time. So, for example, 2 weeks ago, Flexport estimated that about 13% of the Trans-Pacific sailings to the U.S. were blanked or canceled. So then add 2 weeks or 3 weeks to that. We're just going to start to feel that now. This week, twice that, about 28% of the sailings from China to the U.S., Trans-Pacific, have been canceled. So then what we're really talking about is May. May is when we're going to really start to see the effect of these canceled sailings. And it's going to continue into June. It's going to continue into July. And probably into the second half, they just haven't canceled those sailings yet.
Yeah.
So if you cancel, if you cancel 20% of your sailings into the U.S., roughly speaking, you're going to see, significant decrease in imports. You can translate that out to the land.
Right. So it's those are tough things to swallow. Let's break that down a little bit. So if we look back at this chart and put this back up here, earlier you were talking about, so we have this surge that has occurred over the last month in imports, right? And so those are what you're talking about. Those are orders that were already placed, right?
That's catch up orders after the Chinese lockdown. That's all it is. It's just finally getting here.
Right.
It has nothing to do with the cancellations now, which are related to the drop in demand in Europe and the United States because of the pandemic and the cancellation of the bookings. And when everyone canceled, then the carriers are like, okay, you're going to cancel your bookings. We're going to cancel the sailing. Right.
And so and then you see this divergence from truckload here, and you're saying that is you mentioned that why the ports are worried because or having concerns because the containers aren't being picked up.
Right. So the kind of things that are coming into California now are probably the normal kind of items that no one can sell anymore. So what's the point of picking them up? The kind of things that are going to be coming in the future are going to be probably different. PPE and that kind of thing.
Yeah, I think what's interesting here is basically, we're thinking, at least in the near term, we're looking at these imports, these shipments, and you're seeing, oh, look, China's back online. Everything's going to be fine, except for the fact that the demand side has dropped off dramatically, and that's the part that is about to show up in this information. But there's a little bit of a fake head move, if you will, like saying like, wait a minute, we just didn't have time to cancel all this stuff in front of the outbreak. So now that we can clearly see the demand impact, we're going to have this, volatility in the market, if you will, where demand and supply do not really line up timing wise. You're going to have a large amount of freight available where there's nobody buying it. And then eventually you're going to have people starting to buy this stuff, and it's going to take them, as much as 40 days to get it to the East Coast of the United States to replenish it. So that you have such a lag or this wave impact in terms of what's available, how the supply is reacting to the demand, et cetera, that's going to create a lot of weird signals in the market moving forward.
Yeah, the Chinese factories, I've spoken to at least one CEO who has Chinese factories, and they're back. And they were actually back in March. The problem is that they got everyone there, everything's ready, and suddenly at the end of March, the U.S. stopped ordering any cargo. and Europe actually a few weeks before that. So all the Chinese factories are sitting there with nothing to do.
Wow. I mean, we're already starting to see that in the data. We're starting to see that trend down. If you, if you were looking at that maritime shipment from, to the port of Los Angeles, you can start to see those peaks gradually fall off already, which again doesn't necessarily mean that there's a lot of truckload volume immediately falling off, which it did. But again, that wasn't necessarily related directly to the port volumes falling off. It's more of a reaction to the previous March, if you will.
Another interesting thing is that in the past, you would look at the spot rates to move boxes on various routes, and you'd say, okay, if the rate it costs for a box to go from Asia to California was on the rise, that means demand is on the rise. Or if it fell, that means demand was falling. So you could use it sort of as a proxy for demand. But that's completely out the window now, because what the container lines are doing, manipulating the capacity. So you're seeing the rate has actually stayed fairly steady. It's fairly steady year on year right now, which on the surface makes no sense because demand has evaporated. But what the container lines have done is in unison bring down their capacity in a way that keeps the freight rates steady.
And that's
no longer
and that's been some interpretation of that is that they do that just to keep the rates steady, which is a purpose of it. But the blank sailings are there because there's no demand.
Yeah,
the orders have stopped.
Exactly. There's no reason for them to sail those ships if they're not going to be able to fill them.
If there's
it's actually gotten so bad. It's gotten so bad that they're actually telling shippers in the U.S. Hapag-Lloyd, for example, is saying, do not call us with an order more than 6 weeks in advance. So, and they are attempting to keep the rates steady, because if they don't keep the rates steady and the rates collapse, then you're going to see some bankruptcies of some major carriers. Nobody wants that.
Well, no, of course, and nobody in the economy wants that either, because then you've had a severe hurdle to overcome in the supply chain once we do start coming back, right? We've got to protect those supply chains.
Absolutely. If you look at what's happening now versus 2009 global financial crisis, there were many more container lines out there. And over the last 10 years, there's been a lot of M&A deals. There's been the creation of the so-called alliances, the big three alliances, where they're coordinating their capacity. And the good news is that because there's less carriers, there's less of a chance of there being a price war. And there's less of a chance that the prices will collapse. And you could say, okay, if you're a U.S. cargo shipper, we want the prices to collapse because it's cheaper for us. But the problem is if the price collapses, then the carriers go bankrupt. And then that's a huge mess for everybody, including the cargo shipper. So you don't want that.
Yeah, we
want decent, fair pricing.
It's not easy for a new player to get into the maritime scene.
No.
Not going to happen.
No, not going to happen. So from your article on April 17th, what we've been talking about is the volume of containers being unloaded at California ports has surged this month, but it's a final hurrah before a big plunge. And we're seeing those cancellations like you're talking about, and some, what did you say, 6 weeks out? They won't take anything past 6 weeks out as a booking?
Well, one of the carriers has just come out on Monday and said that we don't want any more advanced bookings past because they can't know whether the ship is even going to sail or not. And and the carriers have canceled departures all the way through the end of July, or the end of the first half.
So that begs,
and of course, add 2 weeks.
So that begs the question, Greg, is okay. So we've got some states coming back online. Georgia's opening the nail salons and bowling alleys, which is just solid. Zach is really excited about that. But
the nail salon specifically.
The nail salon specifically. No, but I mean, they're talking about it and trying to figure out plans to get the economy back and going and come back online. So let us hope and pray that all of that is successful. We don't have a re-outbreak, and we do start a good, steady uptick in the economy. How quickly can the maritime react to that and come back with the sailings? And how quickly would they need to? Let's say we started to see a major us come back online and demand start to come back. How long before we see that demand actually come in maritime, and how can they react to that, and how does that affect surface then? I mean, if we started today, how do they reverse the blank sailings, and when would we see that? Do you have any insight into that?
Well, I suppose if you saw the rates start to rise further, that would be an indication of that. And, I guess hypothetically you could unblank a sailing, but I just don't think I think it's likely. I think the other scenario is more likely that this will continue. I mean, I hate to be pessimistic. But it does take time. I mean, once you're going to take a ship out of service, what they're going to try to do after they blank all these sailings is they basically have about half their fleet chartered in. And when those ship charters end, they're going to let them expire. So they're going to shrink their fleet over time. The longer this lasts, the smaller their fleets will get, and then the more time it will take to re-expand. So if something was to happen overnight, sure, they could reverse this. But as this persists, it will become more ensconced, and it will become harder to reverse it quickly. So it'll take time.
So you would say, so we would see rising rates as the first indicator that the capacity is starting to see some stress. Sure, I would think so. Yeah, and so if demand does come up and it takes them longer to do that, we would see reactions in other modes. Would air cargo then see more stress? I would think so. I mean, I'm not an air cargo expert. Right. Yeah. No. And neither am I. I'm just looking at the interplay between the different modes. If we're going to get back online, we're not going to stop. Or it's going to be difficult because, we were talking about earlier. The automotive industry in Mexico. It's hitting Mexico, and they're going into lockdown. But their automotive officials are trying to negotiate or work with U.S. officials so that they can bring both sides back online for the auto manufacturing at the same time. Makes sense. So if the maritime is blanking sailings and dechartering vessels, et cetera, and then we start to come back online, that's going to be some hurdles to overcome. Even if things are honky dory here as far as a resurgence of COVID does not occur, and people are happy to get out there and start going, and there's this demand, it's still going to sputter because that supply chain has been choked.
Yeah, I mean, just to chime in on the air cargo piece, I mean, we're still continuing to see air cargo rates increase from China to North America. So we're still seeing that because obviously the passenger flights, the belly cargo, roughly 50% of the capacity in the world in terms of air cargo volume flies on those passenger jets that are now not flying anymore because there's no passengers to carry. So those rates continue to increase. It's not dissimilar to what we're seeing on the maritime side, where they're constraining capacity because there's no freight to haul. The difference here is that the freight moving on air cargo is a little bit more expedited, a little bit more high value. So you can almost make the argument that, hey, this segment of the industry, the expedited industry, might actually be doing better because of the amount of air cargo freight. But again, you have to keep in mind that 50% of the capacity has gone offline. Just like a large percentage, as you said, Greg, of the maritime capacity, as much as, 30% here in the next month has gone offline now?
Yes, it's unprecedented.
Yeah, so the difference between air cargo and maritime, of course, is the fact that if the rates, the maritime, I don't know their exact methodology in terms of controlling their capacity. What rate level are they going to, as long as rates hold steady, you would think that their cancellations would, maintain. If demand obviously increases, they can increase those rates to a certain point. How far that is, I don't really know. But again, if rates start to fall, do they continue to pull ships offline and cancel more sailings?
Yes, they will. They're going to expect that they'll continue to cancel throughout the rest of the year. And by the way, if the rates go up, there is. I don't want to give the impression that there's no competition here. There is competition, and so you'll start to see people, jump in with ships. So I don't think there's going to be any problems with a shortage of ships.
Right on.
But I just don't see that happening. I think we should think more of the other scenario.
Wow, interesting and also scary information, but your perspective is awesome and timely, as we've had people looking at these imports and thinking this last hurrah, which we now know that's really what it is, was an indicator that maybe things are normalizing a little bit, right? But that's really not the case from there.
One quick addition here, though, especially when it comes to California. What I am hearing about is so-called express services, where you have, it's not like it's that fast, but you're talking, 12 days across the ocean. They're going fast. They're at a faster speed, consuming more fuel. There's expedited service through the terminals. They know exactly where that box is on the ship. They bring it off quickly. And what I'm hearing is that there's a lot of PPE coming over from China right now, and a lot of relief supplies. So that's what we're going to see, and so that actually may offset some of the decline, at least in California, of the traditional cargo.
Yeah,
because air is limited. So if they can't do air, what their option is this express ocean.
Yeah, I think that's an interesting point you're making, not just because you're going to see some of that offset on the rate side for the traditional freight, but the fact that we may actually see an increase in expedited freight moving forward, just because there is less opportunity to ship freight in the places that you need it to ship. So,
meaning less capacity.
They're just going to pull capacity down.
Yeah, right.
That freight that was supposed to move at 8 p.m. on Tuesday, they don't move that truck anymore. So now you have to pay extra to get that freight moving when you want it to move.
Right. Very interesting. And you were going to say something when I said that people were thinking things were kind of normalizing looking at those imports. What did you have a thought there?
Yeah, I mean, normalizing is a strange, word to use at this point.
Well, but yeah, I meant kind of.
They're not.
I was trying to avoid the word bottom.
Right.
What is that, and what is real bottom for the for truckload volume, right? But looking to that as the imports will support at least this level.
Sure.
And that's not really the case at all, as we've learned today, unfortunately. But fortunately for us, we've got Greg Miller, and I thank you so much for being on the show today. Everybody tuning in, really appreciate you watching the show. Today's was really, you look at all the different data sets, you look at maritime, you look at air, you look at rail, you look at manufacturing, as we discussed in the beginning. Greg Miller is an example of that. The human sentiment, the analysis and the context around what is going on that you need to mix with your data and be able to forecast correctly. If you're just looking at the data and the trends right now, you're looking at imports rising and thinking, oh, these are looking good, and the United States is coming back online over the next couple of weeks, etc., and therefore maybe we've hit this or coming close to this bottom and we're going to rise out. Well, blank sailings.
Yeah.
28%, I think he said, was coming offline.
Yeah, I think you're spot on in terms of, we're in a weird time. So that means that we have to basically break out of our comfort zone in terms of looking at information. We have to look at different sources of information to see what's going on. There's going to be a lot of different signals going on right now as the market clearly, works through this confusion, if you will. So looking at as many offsetting data points as you can at this point in time, especially as quickly as you can find them, is going to be tremendously useful as you try to adapt and navigate, what has become a very tumultuous journey through the COVID-19 outbreak.
That's a mouthful.
Yeah.
So excellent. Thank you so much, Greg Miller. Thanks for everybody watching. Thanks, Zach.
My pleasure.
Check out more information on what's going on maritime and air and truckload and what's going on in the markets on FreightWaves.com and American Shipper. You can find Greg Miller on both. Excellent articles, great insights, and information that you need to mix with your data to be able to navigate these markets through these tumultuous times through the COVID-19 pandemic. So until next time, next Thursday, 4 p.m. Eastern Time, FreightWaves TV, I'm Michael Vincent. Peace and love.